gold's moving from west to east, essentially, right? So a lot of the physical gold is going to China, going to India, going to Turkey, going to Russia, as you pointed out, multiple countries throughout kind of Eurasia, the BRICS nations, and so there's that general migration of the physical metal, where some cultures they either have the trade surpluses to absorb it, or their society values it more, views it as more of a store of value, whereas a lot of Western investors have somewhat lost interest in it, and a lot of the Western countries are running these deficits anyway. So there's this general flow, which kind of corresponds to the rise of power of Asia as an economic force in general, and so we are seeing kind of that those interesting dynamics in the gold market. And it's obviously been a long story where multiple people can think they have exposure to gold and not really have exposure to gold. Like if things really hit the fan, if you kind of put the cards on the table, who has the gold? A lot of people think they have gold, but if they actually were to all kind of call on those claims at once, some of them would be obviously left without it. And I think that the market is kind of going through that process to sort some of that out. And obviously that can have long-term implications about price, right? Because if you can increase the supply of claims without increasing the supply of the underlying, that can obviously be negative for pricing. And it's interesting because gold, obviously gold's had a rough year this year, but if you compare it to like long duration bonds, which is one of the closest things you compare it to, gold held up better than most long duration bonds did. So it was, it didn't go up like a number of people would have hoped, but it did some damage control in a portfolio or in a net worth. As we move towards a more multipolar world, kind of, east and west, maybe trusting each other less, or multiple different parts of the world trusting each other less, that question of custody matters more. And so I think that the gold can become less kind of centralized and more spread out to those jurisdictions. And I think that's a general trend. During periods of history where we have kind of these just shifts in how the global financial system works, right? So, you had a shift, in say the 40s, you had another shift in the 70s. I think we're in that kind of era now. When you look at charts of major shifts, there's a lot of kind of similarities here. And so I think that investors do have to be aware of the possibility of nonlinear events, right? Where things change, over the course of a year, over the course of a weekend in some cases, and just things are different after that. And then you could have a pretty significant repricing in some assets. And I think gold is kind of near the top of the list of things that could go through a repricing. And kind of by its nature, predicting something like that is impossible or very hard. It's kind of any given year, it's a low probability event. But I think that we're in that type of decade where some of those low probability events are going to happen. And I think we've already seen some of them. And I think that a shift in how the gold market works and how it's priced, and kind of a check to see who actually has the gold is kind of one of those possibilities. And one of the catalysts that I think could contribute to that is right now, the market does kind of expect that inflation's transitory. If you look at, for example, inflation break-evens, for example, like the bond market's forward assessment of what inflation's likely to be, they're looking at much lower numbers than it is now. Once the Fed gets done with their period of tightening, I think that eventually the market's going to have a reassessment of forward inflation expectations. And that could change a lot of investor behavior around, how they treat bonds and how they look at gold, right? Because right now, with the dollar soaring and with yields going up, and investors kind of expecting that inflation is transitory, they're looking at these things as though they have positive real yields. And so that obviously, when you can get positive real yield on a bond, that can be pretty attractive relative to gold. But if the market reassesses its forward inflation expectations with rates at these levels, and you kind of have reassessment, and you start looking at it and say, what if we're in a long period of negative real yields? Then gold becomes, it gets increased attractiveness. And so I think there are some catalysts to look for going forward. And it's, when I was looking at the bond market, a few years ago, it's just like it's like the market was just not looking into the future at all, or at the same time, it's not even looking into the past. It's not looking in terms of history of what happens when bond markets behave like this. And I think we're kind of still in that environment now, where there's not a full recognition, I think, of how trapped a lot of these highly indebted sovereigns are in terms of their ability to maintain the purchasing power of those bonds. People kind of realize that, some of these issues are going to be with us for a while. I think that could make gold more attractive. And then while you're going through those processes to kind of reduce kind of the games in the market, I think it can kind of result in a repricing. When you look out long term in the United States, we've got structural trillion-dollar deficits as far as the eye can see. And then with the increased interest rates over time, as that some of that debt comes due and gets reissued, basically as that debt rolls over, it starts going up in terms of interest payments by the federal government, and that actually increases the deficit even more. And so as we kind of look out, and that assumes no recessions, right? That assumes no recession in 2023 or 2024, even though, for example, the yield curve is currently inverted. We have kind of a slowing, a decelerating economy. And so even assuming no recession, it is very, very large deficits. And that's generally this type of more inflationary type of environment where you have a deficit that you can't fully control. You can't really raise taxes politically. You can't really cut some of these programs that are very politically popular. It'd be very unpopular to cut them. I think a lot of that kind of forward spending is already locked in, uh, and so I think that in some ways gridlock just reinforces that further. I think that the market is too kind of calm about what could happen with oil over, say, a 5-year period, right? If you look at a lot of analyst expectations when Wall Street analysts, when they look at, say, an oil company and they kind of price out what's going to happen, they usually assume like 60 or $70 oil. They kind of assume that this spike's just going to go back down and we're going to kind of go to this kind of low plateau. Obviously, different shops have different price estimates, but for example, if you look at Morningstar analysts, they're using $60 oil for their long-term assumption. Energy companies have been terrible investments for like a 15-year period. They've generally not done very well. And so it's not like, no, when they were not making money and they were going through bankruptcies, no politician wanted to, save them. But now that they're actually having a profit, there's suddenly like these, people are floating windfall taxes, they're floating nationalization. Obviously, different jurisdictions are handling that differently. And if you're an oil company, you're looking at this environment, you say, okay, well, we don't know what oil pricing is going to look like over the next several years. And we also don't know what percentage of our profits we're even going to get to keep. I mean, essentially, we have all the downside if oil has a bearish scenario, and we could have our upside capped in some way. And so that certainly is not an attractive environment to put billions of dollars into long-term projects. I mean, you can do short-term shale type of work, but if you're going to go offshore, you're going to do some sort of like large investment project. It's not a very attractive environment for that to happen.